In today's question, we are going to discuss about ratios, all types of ratios, profitability, liquidity, investor ratios, gearing ratios, and all those ratios, right? So let's go through this. It has many different types of stores. So now we are going to go through this case study, right? And this is a very good question for those candidates if you want to improve on your ratios and all. If you're lacking some knowledge or formulas on how to calculate certain ratios, this is a good question to learn your ratios. So high K company is one of the three largest supermarket chains in the country of Tanzania. Its two principal competitors, Delhi and Lemster, are of similar size to High. In common with its competitors, High company operates three main types of stores. So they have given the three details of stores here, and also if you go down and see that they have also given you the financial information for the 3 years, and also they have divided it into different types of stores and also the number of stores if you see, right? But we'll go through the financial information later. Let's read what they have given. So town center stores, right? This sell food and drink and a range of small household items. High Company's initial growth was based on its town center stores, but it has been shutting them over the last decade. Although the rate of closure has slowed in the last couple of years. So main thing you have to note about here is that they have been shutting down, but that shutting down rate of closure is slowed, right? Convenience stores. These are smaller and sell food and drink and a very few other items. Between 2003 and 2002 and 3, 20x3 and 20y3. High Company greatly expanded the number of convenience stores it operated. So it greatly expanded the convenience store, right? Their performance has varied, however, and since 2003, High Company has not opened any new stores and closed a number of worst performing stores. So this year they haven't opened not new stores, they haven't opened any new stores, closed worst performing stores. Out of town stores, this sell food and drink and a full range of household items including large electrical goods and furniture. The number of, so they also sell large electrical goods and furniture. That means a significant value of goods and services, right, is sold here. So the number of out of town stores which High Company operated increased significantly until 20y0, but has only increased slightly since. The majority of the town center and the out of town zone town store premises are owned by each company, but 85% of the convenience store premises are currently leased. So convenience stores, okay, 85% of convenience stores are leased, right? But town center and out of town are owned. That you have to understand. This is very important, that which is owned and which is leased. Because when we talk about ratios and all, we have and about financing, we have to discuss about this leasing part. High K Company also sells most of its range of products online, either offering customers home delivery or click and collect, where the customer orders the goods online and picks them up from a collection point in one of the stores. So products online, it could be home delivery or click and collect, where they will pick from one of the stores. High Company's year end is 31st December, when in 2006 results were published in April 2007, High Company's chief executive emphasized that the group was focusing on these three things. What are those three things? Increasing the total shareholder return by improvements in operating efficiency and enhancement of responsiveness to customer needs. Right? So responsive to customer needs. They are focusing on this. Ensuring competitive position by maintaining flexibility to respond to new strategic challenges. Maintaining flexibility and maintaining financial strength by using diverse sources of funding, including making use of making use in future of revolving credit facilities. So they want to make use of credit facilities. Maintaining financial strength, right? Since April 2007, Delhi and Leominster have both announced that they will be making significant investments to boost online sales. So Delhi intends to fund its investment by closing all its town center. Delhi is the competitor company, right? They intend to fund its investment by closing. How they are going to invest in online sales? How they are going to fund that investment? By closing all its town center and convenience stores, although it also intends to open more out of town stores in popular locations. The government of Tauvnia, now this is very important, the government's decision, because based on that, it's going to impact on your financial ratios. So you always have to keep an eye on the government of that company whenever there are some financial information given to you. The government is very important because they can control the interest rate, they can control the tax. So the government of Taufnia was re-elected in May 2007. In the 18 months prior to the election, it eased fiscal policy before the election, and consumer spending significantly increased. This is very important. Because of this, customer will demand more. Your sales revenue or profit will increase. However, it has tightened the fiscal policy since the election to avoid the economy overheating. It has also announced an investigation into whether the country's large retail chains treat their suppliers unfairly. Now, their financial statements and other information are given to you. All amounts are in dollar million, right? So, statement of profit or loss is given to you. Sales revenue, gross profit, operating profit, finance cost, profit after tax, dividends has been given to you for all the 3 years, 2004, 5, and 6. And also, your balance sheet has been given to you. You have been given the market price per share. Also, you are given based on segment, right? The revenue for town center, convenience, out of town stores, and all those things. And also, you are given the value for revenues for online sales, and also you are given the number of stores. Whether it's increasing or decreasing, you can see from this pattern. Now, come to the requirement. Part A, 21 marks. It's not a joke to leave this question. So, evaluate high companies' financial performance. So main is you have to evaluate their financial performance. How will you evaluate financial performance? When this type of question is given to you, even if they say use ratios or don't use ratios, right? Just they say evaluate high companies' financial performance and discuss. What are you going to do? You have to use financial ratios. You have to use ratios. That means you have to use ratio, because without ratio, you cannot evaluate the financial performance of a company. So you should indicate in your discussion areas where further information about high company would be helpful. This thing, don't forget about this thing. This also from in the paragraph, when you write about financial performance and ratios, you need to talk about this as well. What are the other information which you need, which would be helpful for high company? You should indicate that in your discussion areas. Further information. Provide relevant calculations for ratios and trends to support your evaluation. Up to 10 marks are available for calculation. So 11 marks is for discussion. Just because this is 21 marks, don't think that it's fully for your calculation. It is half for your calculation and half for your discussion. So your discussion is equally important. You need to know how to discuss your calculations. And part B is 4 marks. Discuss how high company may seek to finance an investment program. How they seek to finance an investment program. They told that they're going to invest in the online sales. How they're going to finance that? Let's go to the answer. Right? Part A. Before that, we are going to go through the marking scheme, right? So this question has been fairly done well by most of the candidates, because ratio is a question which is very easy to score marks. Easy marks you can, right? It's something very easy. So read the examiner's team comment. Performance of the candidates who attempted this question was good. Sometimes candidates merely stated a ratio trend was increasing or decreasing without attempting to address why this may be happening. Just saying that this increased, that ratio decreased is not enough. My dear students, you need to tell why something is happening. So how this marks is divided, it is like this. The ratios which you have to use: profitability ratios, your liquidity ratios, your solvency ratios, your investor ratios, your other ratios and trends. And this for your discussion: profitability, liquidity, gearing, investor, stores and online sales, conclusion. You need to give a conclusion. You need to talk about the overall, because you are evaluating the financial performance. You are evaluating the financial performance both from the financial and non-financial, not just financial information, but you also need to say non-financial information from the case study. And finally, you have to give a conclusion whether it's improving or not. And for part B, 4 marks, how they are going to finance that investment, 1 mark per relevant point. That means total 4 points you need to tell, right? Before I go with part B, right, I cannot start with part B because I need part A, right? And part A discussion, I cannot, even though here, if you see that discussion is first, that's how it should be. But discussion, I have to leave some spaces in exam to do my discussion, but first I have to go and do my calculation, because without calculations I cannot discuss. That's why this is written under appendix, right? You can leave some spaces for your discussion and keep all your calculations under appendix, rather than doing one calculation, describing it, and writing another calculation, discussing it. It's not an effective strategy. You should not do it. It's a waste of time, because from year to year you cannot just do calculation and write it in words. That's not what they meant. So first we are going to do the calculation, and then I will take you through the discussion. So profitability, gross profit, it is your operating profit divided by sales, right? Easy. Operating profit percentage, operating profit divided by your turnover or sales. Easy. Just see from 2004 to 2006 what's happening to your gross profit margin. It is increasing 4.33 to 5.07 and then to 6.19. That means it's a good. Operating profit is also good, from 0.87 to 2.91% is increasing. Now let's go to asset turnover. Formula also they have given, right? Sales revenue divided by total sales minus current liabilities. So your sales revenue you can take from your income statement, total assets, and your current liabilities you can take from your income balance sheet, and you will get your asset turnover. And asset turnover also, if you see, it is increasing over the 3 years. Now let's go to the return on capital employed as a percentage. So operating profit percentage multiplied by asset turnover. So this multiplied by this will give you this. Just see. 0.87 multiplied by 2.36. Operating profit percentage multiplied by asset turnover will give you return on capital employed. So you don't have to do, for this you don't have to search again from your balance sheet or income statement what you have to do. If you know the formula for return on capital employed, that is operating profit percentage into asset turnover, this will save lot of your time. That's why I always tell you, please memorize your formulas. It really helps and it really saves your time. Now profitability is done. Let's move on to the liquidity ratio. So all these types, profit, gross profit, operating profit, asset turnover, return on capital employed, we have been doing over and over again. These are your profitability ratios. This will come under your profitability. Now let's go to the liquidity ratios. Like I am underlining the main heading. Under liquidity, we have one ratio, that is your current ratio. Here we are not going to do asset test ratio and waste time here. Most of you, what do? You try to find all the ratios, whatever the ratios you know under that heading. Please don't do this. Some of you under profitability, under liquidity, whatever the ratios you know, you started writing all. No, you are getting 10 marks for writing ratios. So make sure maybe around 2 or 3 under each if you can. Then you write. In liquidity, you cannot write asset test ratio. Why? Because we don't know the value of stock. They didn't give the closing stock. They just gave the value as current assets. Let me take it to the balance sheet. Right? Current ratio is, we all know it is current assets over current liabilities. So, but let me take it to the balance sheet and just check. It is cash and cash equivalent, other current assets, but they haven't given you the stock separately. So you cannot find asset test ratio. So don't break your head to find asset test ratio. Just one ratio is enough. You need information to find a ratio. If you want to find a ratio, you just need to see whether that relevant information is there or not. If it's not there, go ahead, don't waste time breaking it and trying to write it. Right? Now, current ratio also, if you see, it is increasing. That means it's good. Liquidity position is improving. Now let's go to the solvency. Solvency. Under solvency, it is gearing you are given, right? So gearing is non-current liabilities plus non-current liabilities plus share capital, but what is this inside the bracket? This can be confusing, right? Market values of share capital percentage. So this share capital when you take, right? This I need to show you how to do it because this requires a little extra work here. This directly you cannot take it. This requires an extra work. Let me take you to the balance sheet. So first year, I'm just going to show for 1 year and the other 2 years you can do. I'm just going to show for the 2004. Okay, so go to the balance sheet and check your current non-current liabilities. Your non-current liabilities is 1706. 1706 plus 1706. Now when you want to find your equity, how are you going to find your equity? Your ordinary share is 800. But are you going to take that 800 here or are you going to take this total equity? Like, are you adding your ordinary share with your reserve and taking as equity and adding with your debt, non-current liabilities? Or are you just taking 800 or what? Okay, so let me tell you, if you are taking ordinary share of 800 here in this question mark, you are wrong. If you are taking the total equity 8248, you are wrong. What you have to take is, they have told you, market price. Market. So you have to use this information, market price per share. You need to multiply that by 800. What is the market price per share? Inside the bracket, let's see, in dollar 3.89 at the end of 2003, 3.17 currently. Please don't go and use this. This is for 2003, for the previous year they have given. Why they have given for the previous year, I will tell you later. For now, just keep as it is. You need to use this 3.54. This is for 2004 and multiply by 800. So it will be here. I'm putting inside the bracket 800 multiplied by share price, which is 3.54. And the answer which you get will be this one. You can do for the other 2 years also. This will be your, where is that? Yes, this will be your gearing, 37.6, maybe 37.5, something round up. So you see, this is how you have to do for the other 2 years also. If you see your gearing, it is reducing, which is good. Because higher the gearing, higher your risk. Now let's go to the interest cover. Interest cover also, if you see without calculating, it is increasing. That means again is good. So interest cover is your operating profit, right, divided by your finance cost. Operating profit divided by your finance cost is your interest cover. All these are easy way, right? It's easy to get it from the balance sheet or income statement. That's why I'm not showing. Wherever there are some tricks, wherever it's not easy to get, only those areas I'm showing. So interest cover is done. It is increasing, which is good. Now let's go to the investors. So you're done with the solvency ratios. Now let's go to the investors. Solvency is basically your interest cover and your gearing ratios. Now let's go to the investors. Investors all have all this dividend, shareholder gain, dividend gain, return to shareholder, price earning ratio. All these are ratios of investor. Everything which is related to investor. Just think like that. If you, in case in the exam you forget what are the ratios under investor, this is how you remember. Investor, what do they want? They are interested in dividend. So dividend yield, dividend cover. Two ratios you got. Now, price earnings ratio. They care about price over their earnings, right? PE ratio. And also return to shareholders, the share price gain or a loss. So everything related to dividend and share price or PE ratio or EPS, earnings per share, all these are your investors ratio. That's it. So first we are going to start with dividend cover, right? Dividend cover. How did they get the dividend cover? What is the formula for the dividend cover? Let me go to they have got 0.35, right? Dividend I have to get from here. Yeah. How did they get the dividend cover? So I'm giving you some time. Please analyze this and tell me what is the formula for dividend cover. You can use your Google or you can find out what is the formula for dividend cover. I'm giving you 1 minute. Please go and check. Okay, so dividend cover formula I will write here. DC, okay? DC stands for dividend cover. Dividend cover is your EPS, your earnings per share divided by your dividend per share. Okay, so I'm going to write DPS, right? EPS divided by your DPS. So that means your earnings. Earnings per share means earnings divided by per share, right? Share price. Here, dividend per share. Just do the reciprocal. Dividend per share. So share price divided by your dividend. So share price gets cancelled, earnings over dividend. So your earnings is this profit after tax and your dividend is 52. So 52 over 150 is your dividend cover. Basically, in short, dividend cover is your earnings divided by your dividend. So your earnings, so your this dividend cover is 0.35. Just go and check. That's what we got here. 0.35 and fine for the other 2 years, and interest cover also if you see it increased significantly. Now let's go to the price earnings ratio. So price over earning, right? It is 54.46. It fell down to 5.52. Okay, so price earnings ratio. It's your price over your earnings, right? I'm giving you some time to find out price earning ratio from this. You are going to calculate now on your own and see whether are you getting that 52 point, the answer which they have got. Right? So price divided by earnings, right? So here 3.54 multiplied by 800. So it will be here, I'll write it will be 800, right? PE ratio 800 multiple because price over earnings. So 800 into 3.54 multiply by your earnings, divided by your earnings. What is your earnings? Profit after tax, 52. You shall get 54.46. That's exactly what we got here, if you see. Right? It has reduced, which is not so good. Now let's go to return to shareholders. To get return to shareholders, you need two things: dividend yield percentage and share price gain or loss. How much the share price has increased or decreased? The amount, the percentage, by how many percentage the shareholder increased or decreased. If it increased, share price increased from 1 year to the next year, it's a gain. If share price decreased from 1 year to next year, it's a loss. And dividend yield, right? Dividend has been increasing, so therefore you see all the figures are in positive of dividend yield, but in share price you see it's in loss all the 3 years, but the loss is reducing, right? First we are going to find the dividend yield. How to find the dividend yield? What is the formula for the dividend yield? What is the formula for the dividend yield? You can search in your Google. Right? So the formula of dividend yield is annual dividends per share divided by current share price. Right? Annual dividends per share divided by current share price. Let's go and check. So what is the annual dividend? It is 150. And what is your share price? Right? So it is your dividend, which is dividend yield dy. Your dividend divided by, right? Because it is dividend per share divided by current share price. Current share price. So dividend is 150. Current share price, it will be 3.54 into 800. You should be getting this answer, 0.05. No, 5 point, it was 5.3, yes. 5.3 as a percentage you are taking, yes. So you need to multiply that by 100, because yield is as a percentage, you'll be getting 5.3%. You are getting 5.296 something, round up, so you will get 5.3. Likewise for the other two also. Share price gain or loss. To see the share price gain or loss, we need to use this table. The share price where the market price has been given to you. Yes, now you need to use this 3.89. Why they have given you that previous year share price? To see the change, it increased or decreased, whether it's a gain or a loss. So you can see from 2003 to 2004, from 3.89 to 3.54, it's a loss. Then again from 3.54 to 3.34, again it's a loss. Then again from 3.34 to 3.23. That means in short the market price per share has been reducing in all these 4 years, which is not a good news. Right? But how much? I'll show you one. If you want to check for this one, right? So it's 3.89 minus 3.54 divided by the previous year, which is 3.89. right? And you'll be getting 9%. We are getting 8 point something, just round up. We are getting here 9. And it will be in bracket because it's a loss. Share price is reducing. 9, 5.65 and 3.29. Add your dividend yield with your share price, gain or a loss, and you are getting the total, right? If you see the total also is, it was negative first and then it increased. It was increasing. So which is good. That means return to shareholder is increasing. Now let's go to the revenues too, right? Revenue divided by your store, right? So for that, it's easy. I'm not going to show you for all, but I'm just going to take you here. So here, you know your revenue. So basically, your revenue, let's say, is 5265 divided by number of stores. That's how you're going to get your revenue store. Your revenue for each store, right? Because they have written the formula revenue divided by store. And you see town center has been increasing slightly. Convenience also increased. Out of town also increased. Very slight. And now we are going to see the store revenue per staff member. That means your store revenue, you are going to divide it by the staff member. And that also is increasing. Right? So now we have done all the calculation. Please keep it aside you when you are writing this discussion, when you are learning for the first time. Later you try to do this question again and see where you are. So now first we are going to start. See, when you are starting your ratio, the way you start at your ratios, it's better you do your discussion also. There should be some consistency. It's easy for you to write. Right? You started with profitability. Now when you are writing, write with a proper subheading, profitability. Under that you are going to talk about only about the profitability ratios. Right? So the way you started your ratios, let's take you to the profitability ratios. How you started with profitability, gross profit margin, operating profit margin, asset turnover, return on capital employed. So it's 1, 2, 3, and 4. You can start in this order. 1, 2, 3, 4. And then liquidity, then solvency, then invest, and then like that. And then the conclusion. So first we are going to talk about the profitability ratios. It's quite big. So I'm just going to speed up a little, right? When you're free on your own free time, just read it slowly and just see whether you're able to understand or not. But I'm going fast for now because it's quite a long one, right? So the revenues from different types of stores and online stores have all increased this year. Yes, we have just saw that it increased. So just see the first line, how briefly they are saying, rather than saying this increased from this year, this store increased from this year, this store also increased from there, rather than saying everything together they are putting. So this method of writing, this technique of writing, you need to adapt as an AFM student. Writing brief but writing to the point, covering all the points in one sentence is a key which you need to master, rather than writing for, see, everyone can write if you give them enough time. If you give them to write, they can write paragraph, they can write pages on pages. That everyone can do. You don't require a skill in that. What requires a skill is to summarize everything. All the main points needs to be covered in short sentences, brief but to the point. You're not beating around the bush. Short means does not mean that you are excluding points. You're not writing the main points. No, you have to put the main points. It needs to be there. But everything together you're describing as a whole. This saves your time. It makes your work neat. It gives a clarity. And it's easier also for the reader to read rather than reading pages and pages and pages. Your first line when someone reads, always remember this point when you start to write. When someone reads, think from the reader's point of view when you're writing, how the reader is going to see your reading. So when someone reads your first line, they should be able to understand what is happening with the profitability from the first line is here. Now I'm just reading the first line. I didn't read it in detail. I just read revenues from different type of stores and so online sales have all increased this year. That's it. So I know in short, this company is a good one because revenue is increasing. So it's the first line, through the first line itself, I'm getting a picture that the revenue in this company in all the stores and online store is also increasing. That means it's good. So this you need to write. Despite a drop in store numbers. If you see the store numbers, it has been dropping. I'm not going to take you over and there. It will waste a lot of time me going there, showing you and coming back here. So just go and see in the store number in your question, the store numbers was decreasing. Even though the store number was decreasing, you have seen that they're selling some of the stores, so it's reducing, but still the revenue was increasing in all the stores, even in online sales. So the increase in revenue, they just didn't say it increased. Now they are giving reasons why it increased. The increase in revenue this year may be largely due, however, to the government-induced pre-election boom in consumer expenditure. How they have linked. So this is number one reason why they are saying that revenue increased this year. Because before election, they told government eased the fiscal policy. They significantly increased consumer expenditure, the government. There was a boom in the economy before the election, pre-election. See how they are using the case study to prove their point. They are giving the reasons from the case study itself. They are not giving some general reasons that price is low, prices, the volume is high, price is low. That's why revenue is no. Don't write these points because of this revenue is higher. And just see all these points about government having all this in the first three line itself. They having wrote the important points, right? Without wasting time. So in exam also, you will not have so much of time to write all your important points. You must be thinking, I have this 5-6 points to write. I will slowly write one by one. Don't do that. All your important points, try to write as fast as you can, because later you won't get time. If you get time, extra time, then you can elaborate on that and write more. But all important points need to be written first. Don't wait to write it till last. Okay, so because of this pre-election boom in consumer expenditure, which appears unlikely to be sustained. Unlikely to be sustained. So they are saying that it's not easy to be sustained. Why? Why? Are they repeating this from the case study? Just see what they told in the case study. When you read your case study, they have told that government is going to tighten the fiscal policy after election and all those things. Are they repeating that thing here exactly? No, they're just saying unlikely to be sustained. That's it. Very short, but understood. It is understandable. You can understand. So when you give reasons from a case study, when you're using the case study also does not mean that you are going to copy paste the exact lines which they are using. No, you have to write in your own words. You are not going to copy paste. Now, remember the case study also told you one more thing. The requirement A also told you one more thing. What are the other information which they might need? You need to discuss those. So here they are talking about, because the split of the profit, this you have to give from your own understanding under the scenario. This you cannot learn from any textbook and all. What are the types of information they need? This based on that case study, they based on that question, from scenario to scenario it will change. So this cannot be taught to any student in a class, that when this question comes you ask this question. No, everything cannot be taught in the classroom. There are things which you need to think out of the box. You need to have that presence of mind in the exam. There are things which you need to, from your understanding, from your own experience, before experience, whatever you have gained from whatever you have read, you need to answer. Everything cannot be taught in the class. So don't expect all the teachers that they will tell everything. That's why most of the candidates, most of the students, they come to me and tell me, Sabi, I never saw this question before. Sabi, I never expected this question. My past paper was different. We never did this type of question. Yes, this is ACCA. Come on, expect this type of question. Expect the unexpected. You will not expect questions, you will get those type of questions. What counts more is how is your presence of mind. Do you have the strong presence of mind? Can you handle any type of question? That time you can say, I don't know, I don't know, I don't know. Yes, you don't know, you might not know everything, but at least you have to cover it up somehow. So this type of questions are such type of questions. So everything, don't try to go and search in the textbook. You will not get anywhere. You will not even get in online also. When you Google also, you will not get this type of questions. When you ask your friends also to teach you, you will not get this point. Because from friends to friends, if you see, this type of answers will differ. He might think something else, you might think something else. But ultimately, both of you are correct on your own way, right? Therefore, always when you review also, check. Don't try to memorize the answer by short. You will never get the same question again in the exam. So there's no use of by hearting. Never ever you will get the same question. Maybe the question might be different. Maybe the question might be same, but the case study, they will change the case study, the scenario, everything else. So don't think also, right? This is not knowledge based paper. Don't think that I will memorize and I will try to put this answer there. It will not work. Right? So now let's go to, okay, yes, this one. I was starting from here. So because the split of the profit is not given, now you see, imagine if split of profit was given in this question, then if a candidate write, because the split of profit is not given, does it make sense now? Split of profit is given to you in the exam, but just because you memorized this while a candidate was preparing for his exam, he memorized this split of profit is not given, and what he does is in his exam split of profit is given, but he still goes and writes split of profit is not given. This what happens when you memorize, right? So just see, if something is not given, you need to talk about those points. Don't talk about those points which is given there. So split of profit, if you see, is not given. How the profit is arising from each store is not given. Just generally they have given the profit after tax. That's it. So split of profit is not given. It is impossible to tell what has been the biggest contributor to increase profit. Right? We saw our gross profit margin, our revenue, everything was increasing, but we don't know from which store our biggest profit is coming from because the split of profit was not given. So profit as well as revenue details for different types of store would be helpful. Also profit details for major product lines. See all these things which you're giving, right? It comes from your own thinking. The wider you can think, the more marks you can get. It goes like that. The more you can think, the more broad you can think, the more ways you can think, the more answers you can come up with, the more marks you will get in any paper. In any paper in ACC, this works. This formula works. Right? Now, they are saying improvements in return on capital employed derive from increase in profit margins and asset turnover. Why? Why? Why improvements in return on capital employed derive from increase in profit margins and asset turnover? Why this two? Why if this two ratios improved, then all the return ROC will improve? Because when you saw the calculation, what is the formula for ROC? ROCE. It is the profit margin multiplied by asset turnover, right? So in short, if your profit margin asset turnover improves, ROCE will improve because the ROCE formula is made from this two equation, profit margin and asset turnover. That's why. Now, right? Try to put into different paragraphs. Just see here, they are using one paragraph here, one paragraph. This they are describing, right? And just see how they have written answer, right? Here they have told improvements in ROCE derived from increase in profit margin and asset turnover. So what they did was, here they talked about gross margin in one paragraph. Why is it going in one paragraph? One para. In the second para, they talked about asset turnover. Just see how they have beautifully they have presented this answer. One line they told ROCE improved because of increase in profit margin and asset turnover. In one paragraph, they are talking just about gross margin. Second paragraph, they are talking about asset turnover. This is how your answer should be. You're not putting everything in one paragraph. So let's talk about the first paragraph, improvement in gross profit margin. Maybe now they're saying, okay, why that margin itself increase? Maybe, right? See, they're not sure. They're saying maybe, right? Because there's no clear cut information as such why it increase, because you're not given the cost, you're not given the expenses. How do you know gross margin improved, right? So they're saying maybe. Whenever you write, try to write this words like maybe, could be, possibly, perhaps. Try to use these words as much as possible. In AFM, you have to use this kind of words only. You can never be clear cut, you can never be 100% confident and sure. But still, you have to go with the decision. You need to use such kind of words. Please make yourself adapt to this kind of words. Maybe, perhaps, could be, might be, right? Possibly, this kind of words. I think I should do some classes on that too. So if you want such classes, do let me know what words to use in which situations. Maybe I should do a class on that too. Okay. So improvement in profit margins may be due to increased pressure being put on suppliers, in which case they may not be sustainable because of government pressure. Just see. I think I should use a different pen here. Okay. Right. So being put on supplier pressure, and the other one they are talking about here. Okay. So they are talking about the other one is government pressure. I have underlined in different line, different color for you to understand the two relationships, how they are saying this. Please keep your case study question in front of you when you're reading this answer with me. It's very important that you keep your case study beside you when you read this, see these videos. Otherwise, you will not be able to understand that link. That connection will be lost. Because it will save time rather than again you going and trying to understand. Learn it one time, one, and that's it, one and final time. Don't try to reread and waste time. Understand something for once completely and finish it off. So yeah, where were we? Yes, we were here. So the improvements in gross margins may be due to increased pressure being put on suppliers. Why that increased pressure is being put on supplier? Why that increased pressure being put on supplier? To cut down cost. Maybe. See, they haven't been given any information. So that's why they're using this word. Maybe it's possible that maybe they're putting pressure on supplier. Why are they putting pressure on supplier? To reduce the cost. Because if the cost is reduced, then only their gross margin can increase, right? Your cost of sales has to be reduced. Then only that gross margin can improve. Your cost on purchasing. If you're purchasing raw material from your supplier, right? If you're purchasing raw material from your supplier, that cost needs to be reduced, that cost needs to be cut back. How that cost will be cut back? See, your supplier will automatically will not come and cut down cost. No one wants to do that unless they are pressurized to do that. So you have to pressurize that supplier to cut down the cost. It also depends on your bargaining power. If you have that bargaining power on your supplier to force them, to pressurize them to cut down costs, and if they do, then there's a chance that your gross margin will improve. That's what happened, right? But they are also saying in this case, in which case they may not be sustainable because of government pressure. Why they cannot put supplier pressure on supplier in this case? See, they want, no one can stop them. It's not illegal. But here in this case, it is not sustainable. They cannot maintain this, keeping pressures on suppliers. They cannot do that. The government will not let that happen. The government will pressure not to put pressure on supplier. Why is that? How are they saying this line? Okay, I will tell you why. This is why reading case study, understanding it deeply is very, very important. Just check here. Okay. Somewhere government has told something. Yes. It has also announced an investigation into which the country's larger retail chains treat their suppliers fairly. They will do an investigation into a company to treat their suppliers, whether they treat their suppliers unfairly or not. You cannot treat your suppliers unfairly. So if you pressurize your supplier to reduce the price, you are treating your supplier unfairly. This is the reason they are saying this. See, this is why I tell everything is based on case study. This you cannot learn generally. These are not some general points. This is based on your case study, what you are saying. Okay, now let's go to the next one. So the increased sales per store employee figures certainly reflects a fall in staff number. Now they are saying that there's an increased sales per store, right? We have divided sales by the store and staff number or store employee. We saw that there's a rise in that figure. Why is that rise? Because there's a fall in staff number. If you see staff numbers have fallen, what happens? You are dividing sales by your staff number. So your staff number, your denominator, if your denominator reduces. I've told you once, one day in one of my video, I forgot that when your denominator reduces, your number increases, and your numerator increases, your number increases. So here your denominator is your staff number. It is reducing means your number will increase. And improving profit, right? Improving operating profit. Of course, if your sales per store employee, it's a profitability ratio, right? So it will improve your operating profit. Although it could also be used, also it could be due to staff being better utilized. See, they're just not giving one reason. They are just not saying that because there's a fall in staff number only, there's an increase in sales per store employee. They are also giving other reasons. They're saying that maybe why the staff is reducing, although it could also be due to staff being better utilized or increased sales of higher values in terms of larger stores, right? Maybe you are increasing sales. Maybe there's an increased sales now of higher values in larger stores. That could be one reason. Another reason could be maybe their staff is being utilized better, right? So if staff numbers continue to be cut, see, they're giving the disadvantage also. It's not good that you keep cutting staff. In one way, it's good. Yes, your cost is saved. You don't have to pay salary to your staff. Also, your current staff, remaining staff is being utilized better. But at time, you cannot cut down store. There's a limit to that. So if staff numbers continue to be cut, however, this could result in poor service to customers. This could lead to poor customer services. There will not be enough staff to deal with the customer. It's like too many customers but very limited number of staff. They will not be able to give proper service to customer, leading ultimately to decreased sales. So this will reduce the customer. So always you don't have to discuss what has happened. You can also give scenarios what will happen if things works differently. If things are not like this, how something can happen. That's what they started describing from here. This is something they are worried about. This something, if it continues to happen in future, what could happen? That's what they're saying. So always try to put this kind of answers also in your answer. It helps to get you good marks. What happens? Think more. Think. You have to think for your future too. Not just what happened today, but what implications, what effect of this decision could happen in my future. So all these things you need to take care about and need to write. So they are saying that if they continue to cut down staff, it could lead to decreased sales. So again, it is questionable how much high K company can go. Now let's talk about the asset turnover. I know I'm putting too much of time discussing this ratio, profitability ratio, but there is no other way. It needs to be taught like this. Otherwise, if I wanted, I could just rush through, but I don't want to rush through. I want you to understand a concept very properly embedded in your system, so the second time you don't have to learn it again. Once you are learned once and forever, that's it. That is my aim. Something when you learn, it has to straightly go in your mind and be there. Asset turnover. Asset turnover shows an improvement which partly reflects the increase in sales. Okay. There has only been limited movements in the portfolio of larger stores last year. The fall in non-current assets suggests an older. Go to balance sheet and see there's a fall in non-current assets here. Non-current assets is declining. Why is that? It suggests an older, more depreciated asset base. If there is no significant investment, this will mean a continued fall in capital employed. Right? Your capital employed will reduce if there's no significant investment and improved asset turnover. However, in order to maintain their appeal to customers, older stores will need to be refurbished, and there is no information about refurbishment plan. So this is another piece of information which is not there, which would be useful if it's there. Information about recent impairments in asset values would also be helpful, as this may indicate future trading problems and issues with realizing values of assets sold. Let's go to liquidity. See, current ratio we saw it has improved, although the higher cash balance, if you see your cash balance, it is increasing in your balance sheet over the 3 years, right? So higher cash balance have been partly reflected by higher current liabilities. How that higher cash balance came? How that higher cash balance came? They are saying that higher cash balance came by higher current liabilities. Go and check your current liabilities also. You will see your current liabilities also increasing. So your cash is increasing, current liabilities increasing. What does it mean? This is a basic knowledge you should understand. This is nothing about AFM. Cash balance increasing, current liabilities increasing. That means most of you are not paying your creditor. You are taking on credit from your supplier. You're taking goods on credit from your supplier and you're not paying them. So if you're not paying them, no cash is going out from your business, right? It is retained. The cash is retained in your business. So your cash is also increasing, while your creditors is also increasing. Because if you have to pay your creditor, if you are, then only your cash balance will decline. It will go because from your cash you have to pay. But now you're not paying your supplier, so your supplier, your creditor is increasing, your cash is increasing, right? The increase in current liabilities may be due to a deliberate policy by taking. See, now they are using such kind of words. Always you will see in AFM, this kind of words are always repeated. Always it is repeated. Right? May be due to a deliberate policy by taking more credit from supplier, which the government may take measures to prevent. Right? Why they will take measures to prevent? As earlier I told you, that government is announced that they are going to see whether the supplier has been treated fairly or not. From the case study I'm talking. Right? So if you're taking more and more credit from supplier, that's also not fair for the supplier. So government will take measures to prevent that you are not able to take more credit from supplier. They will make sure that it happens. So being forced to pay suppliers sooner will reduce cash available for short-term opportunities. If you are forced to pay supplier by the government, that you have to pay your supplier by cash, what happens? Your cash will reduce, right? So you're just not talking what happened currently with your cash balance or what. Now you're talking with this line. You are also saying what will happen in the future if these things happen, right? Gearing. Let's go to the gearing ratio. The gearing level in 2006 is below 2004. We saw that gearing reduced, but it would have fallen further. That means they are saying that they fell down, but by a very small amount. They are saying they could have fallen more. It could have gone more down had a fall in debt not been partly matched by a fall in share price. If you go and check your long-term loan, long-term liability, right? It is reducing. Your share price is also reducing. So because at the same time your share price is reducing, your debt is reducing, that's why that fall is not very big, right? That fall is not very big. But if there was a difference between the fall in the debt and the fall in the share price, if there was a big difference, then that fall in gearing level would have been much higher. It would have fallen more down. That's what they meant. It seems surprising, right? Share price also we saw it fell down. Debt, go and check your long-term liability. So it seems surprising that high companies' debt level fell during 2006 at a time of lower interest rate. This how are they saying? Go to your income statement and check your finance cost. Your finance cost is your interest. Go and check your interest also fell down. So it is quite shocking, right? It will be surprising because usually what happens is when your interest rate reduces, we borrow more. We keep on taking more loans, more debt and all. But here this is surprising because your debt is also reducing. Your interest is also lower at that time. So it's quite shocking, right? Possibly, lenders were rightly skeptical about whether the cut in the central bank lending rate would be sustained and limited their fixed rate lending. Possibly, I told you, these are the words which you have to use. Maybe, possibly, could be, might be, perhaps. You can never be sure. You always have to use such words, right? So they're talking about the lender side of view. What happens when with the central bank lending rate and all those stuff. So interest cover, if you see it improved in 2006 and will improve further if high company makes use of revolving credit facilities. That means what happens is, what is the formula for the interest cover? Interest cover is your profit after tax divided by your finance cost. That is your interest, right? So if you take care, right, if you make use of revolving credit facilities, what happens? Your interest cover will improve. Your interest cover will improve. Because your credit facilities means credit has to do with your debt. You're taking a debt. Debt has to do with your interest, right? So your interest is increasing. If your interest is increasing means what? Interest is tax deductible. Remember that your profit after tax will increase. Your profit after tax will increase. It will increase your interest cover. However, when high companies loan comes up for renewal, terms available may not be as favorable as those high company has currently. Now let's go to the investors. So the increase in the after tax profits, you see after tax profit from your income statement, it increased, has not been matched by an increase in share price, right? Which has continued to fall. So your earnings increased but your share price fall. That's why how they have beautifully linked this to PE ratio, price earning. Before they talked about price earning ratio, they told earnings increased, share price reduced, therefore P price earning ratio has been falling from an admittedly artificial high level. And the current level seems low despite earnings and dividends being higher. See, even if your earnings and dividends are higher, your PE ratio is lower. Why is that? PE ratio, look at the formula for PE ratio. It's price over earnings, price divided by earnings. That means price is your numerator. That means your share price. So share price, numerator is falling down. Share price. earnings is increasing. Earnings is increasing. I'll write it clearly. So your earnings is increasing, share price is reducing. Okay, what happens? Your P ratio will fall. When your numerator reduces and your at the same time your denominator increases, your number will reduce. You can check this with some few numbers and see how the P ratio will change. Right? You can use some artificial numbers and check imaginary numbers. So the stock market does not appear convinced by the current strategy. Why they don't appear convinced? PE, the price earning ratio fell very low from 55 point something to I think 5 point something it fell down. So in this situation they will not be convinced, the stock market, right? So the return to shareholders in 2006 has continued to rise, but this has been caused by a significant increase in dividend and hence increase in dividend yield, right? That return to shareholder is increased mostly because of that increase in dividend. That's why there is an increase in dividend yield. And also the continued fall in share price after the year end suggests that investors are skeptical about whether this increase can be maintained, right? When a share price is falling, investors become skeptical. It's not a good sign when share price keeps falling. Now let's go to the revenue analysis based on different stores, store by store, right? So first we are going to talk about town center store, then convenience, then out of town, and then online stores, and then we are going to talk about conclusion. Right? Okay, so town center stores. Now, High Company has continued to close down close center stores, right? They continued, but closure have slowed recently. This exactly they have taken from the case study, but they have just twisted the words here and there, right? The closures have slowed recently and revenue increase in 2000. This suggests they may have selected wisely in choosing which stores to keep open. Although, see, they are saying even though they are selling off the closing down some of the stores, still they are making good revenue. What does it mean? What does it mean? It means that company is wise enough to choose which company to keep open, which company to close. That's why the revenue is increasing. That means that decision is a wise one. Although Delhi company believe there is no future for this type of store, even though the company believes that there is no future for this type of store, all this they're talking from the case study only. Nothing to break your head from, right? No theory, no knowledge. No one will tell you. From the case study itself, they are saying there's no future for this type of store. Arguably, Okay, arguably, though, town center stores appeal to some customers who cannot easily get to out of the town stores. Town center stores may also be convenient collection points for customers using online click and collect facilities. Remember about that online click and collect facilities? Who want some store where they can collect? In online, they are clicking, but they are going to some store to collect that. So this could be that convenient point. This town center stores. Whenever some piece of information is there, never treat any piece of information in isolation. All the piece of information are connected here, there. You need to connect together like this and talk. Once you're able to do that, AFM is nothing for you. You can easily solve each and every question. The only tough thing is integrating everything in the case study. Now let's go to the convenience store. Beautifully they have given the different subheadings. Need to talk, right? Convenience store. High Company has invested heavily in this since 2003, right? From the case study they are talking, the figures in 2004 suggest it may have been overextended itself or possibly suffer from competitive pressure and saturation of the market. The 2000 wide results show an improvement despite closures of what may have been the worst performing stores. The figures suggest that Delhi company's decision to close its convenience stores may be a premature, possibly offering High Company the opportunity to take some over of its outlet. Just read from here to here. They are saying, see, we have been told in the case study that Delhi company, what are they doing? They are closing their convenience store. Because they are closing their convenience store, this could be that was a premature decision, I could say. It's not a wise decision. But because of that immature decision or premature decision, High Company can take advantage of that opportunity. They can take over those outlets from the Delhi company. Delhi company is selling, right? or closing those stores. So high company can take over those company from Delhi company, right? The convenience store, because they are having their improvement is they're having an improvement. And also they are saying why convenience store should be maintained, because maintaining its convenience store presence would also seem to be in line with the high company's commitment, right? What was it commitment? There were three commitments they told: to be responsive to the customer needs, to be responsive to the customer needs. Please check out of those three. I think the first or the second one was responsive to the customer needs, right? So one of their commitment was this. So if they maintain this convenience store, they are saying they can fulfill their commitment. They can be responsive to the customer needs, right? Profitability figures would also be particularly helpful here to assess the impact of the rental commitments under leases. Why leases? Because they told that convenience 85% of convenience store is under leases, right? High company only owns out of town stores, and most of the out of town and the town center stores are owned by high company, but convenience store 85% of them are under leases. So in this case they are saying if the profitability figure is given to them, they can assess what is the impact of the rental commitments under leases, because under leases you have to pay rents, right? So what will be the impact of that rent on the profit figure? That will be very useful here. Now let's go to the out of town stores, right? Although the revenue, right, where am I, right, although the revenue per store out of the town stores have been shown limited improvement in 2006, not very big improvement, little only. This is less than that might have been expected. The reason customer boom would have been expected to benefit the out of town stores particularly because expenditure on the larger items. Why expenditure on the larger item they're talking about here? Because if you see out of the town stores, they sell larger items other than food and drinks, like furnitures and all those things. So here it is expected that they are going to perform better, right? Because expenditure on the larger items which they sell is more likely to be discretionary expenditure by consumers, which will vary with the business cycle. So where daily company sizes new out of town stores will also be a major issue for high company, right? Where, because they told in the case study that they are going to go for a better location, new location. The daily company, it's the high company's competitor for the out of town store. So where they locate is also going to be a major issue for the high company, as it may find some of its best performing stores face more competition. High company again may need to consider significant refurbishment expenditure to improve the look of the stores and customer experience in them. Now let's go to the online sales. Online sales have shown steady growth over the last few years, but it is difficult to say how impressive high companies' performance is. Comparisons with competitors would be particularly important here, looking at how the results have changed over the years compared with the level of investment made. See, they are not given any results here to compare with themselves or with the competitor. So it's difficult to say how well the online sell high companies' performance is in the online sales, right? It is also important to tell from it is also impossible to tell from the figures how much increase in online sales has been made at the expense of store sales. Yes, they're saying increase in online sales, but what would be the impact of this in the store sales? Are are you going are you are there going to be any negative impact on the revenue from the store sales? Are your revenue going to get affected? Revenue from the store sales going to get affected because of your investment in online sales? That also you need to take into account. So by looking at the figure itself, you will not be able to tell what will be the negative impact on the store sales. Now let's go to the conclusion, right? So finally, now they are giving the conclusion. Whenever evaluation question is there, when you have to evaluate some performance or some financial something, at the end you have to give a conclusion, right? They will not tell you give a conclusion, but you need to give this conclusion. So if high company share prices to improve, investors needed to make some sort of definite decision about strategy the way its competitors have since its last year end. What the chief executive has been saying about flexibility and keeping a varied portfolio has not convinced investors, right? Chief executive, what are they saying? That there has to be some flexibility and there should be a varied portfolio. But remember, investors are not convinced by the chief executive's decision. Why? Because they can see that the company's share price is not increasing, it is reducing. If high company is to maintain its competitive position, it may well have no choice but to make a significant further investment in online operation. It has to make investment in online operations because the competitor companies are doing so, right? Possibly, as well as it could review whether its competitors is closing convenience stores, as it may be able to open with limited investment new stores in location with potential. However, it also must decide what to do about the large out-of-town stores as their performance is already stagnating and they are about to face enhanced competition. Right? Just check here. Just check this. From 4.645, slightly 4.646. What's happening? Revenue is not increasing. Just check all the 3 years. It's stagnating. Whenever a profit is stagnating or something, it will be very close. That change will not be so much. Right? So it's clear from this that it is stagnating. Right? Because the profit is already stagnating and they are about to face enhanced competition. They will face enhanced competition because when something performance is stagnating means when revenue is not increasing so much means they are facing a competition, right? So high company will also need to determine its dividend policy with maybe a level of dividend which is considered the minimum acceptable to shareholders allowed for in planning cash outflows, right? Now, so part A is done. You will get marks for alternative calculation and discussion also if you have some answers other than this, but make sure when you have answers other than this also for the candidates, please make sure that you show this to someone who has knowledge of this, who can mark your paper and give you marks for those, because it's very hard for you to mark your own paper, right? So make sure you show this to some verified experienced tutor or someone. Now part B talks about how we are going to finance the investment. It's just 4 marks, so 4 points we are going to talk about. So right, 4 points, 4 different paragraphs, 1 2 3 4. Let's see first what they are saying. High company has not raised any equity finance over the last 5 years. We have checked the equity finance. It was 500 sorry 800 800 800. It has not raised any equity finance over the last 5 years. We know that. So its falling share price means we know that the share price is falling. So its falling share price means that a new share issue may not be successful. See how they are linked. Because their share price is falling, if they go for the share issue or equity finance, not possible. It's not going to be successful. This is how you have to link that. It may not only need debt finance to be renewed, but additional funding to be obtained. See, just getting debt finance to be renewed is not enough. They need additional funding also. High company intends to make more use of revolving credit facilities. We saw that they are going to make more use of revolving credit facilities, which it need not draw on fully rather than loans, which will mean that its finance costs are lower than ordinary debt. Right? However, these facilities are likely to be at floating rates. So if the government increases the central bank rate significantly, we all know the disadvantage of having floating rate. Suddenly, if the government increases the central bank rate, they could come at a significant cost if high cost decides to utilize them fully. Finance cost on new debt, whatever form it takes, may therefore be significant and lower interest cover. Right? Why? What they're saying, how is it lower interest cover? Because of high finance cost. Because your interest cover, what is the formula of interest cover? Profit after tax, no, operating profit, I'm sorry. Operating profit divided by your interest or your finance cost. Yeah, your finance cost. Same only, interest or finance cost. So your finance cost, if this denominator goes up, it increases, your number will reduce, so interest cover will reduce, right? So finance cost on new debt, whatever form it takes, therefore with significant and lower interest cover. So what you should do now, you have told that equity finance is not possible because share price is reducing, it is not successful. Debt is also not possible in this situation because if you take debt, your interest cover will go down. So what is the option left? Hmm? High company may have to investigate. See, may, again they are saying may have to, they are not saying they have to do it, they should do it, they must do it. They may have to investigate selling some of the stores it owns. Some, see, you can sell something which you own, or either outright or sell or a leaseback basis. So these are some of the ways in which you can raise your finance, through which you can raise finance to invest on online sales, right? You can sell some of your stores which they own, or they can sell or lease back basis, the leasing ones, right? Your convenience stores is on a lease basis, so you can sell and lease back later. So this is how. Next we have question 6. So that's it for today. We have covered all the ratios and how we are going to discuss each ratios and the conclusion and how we are going to finance that investment, all this about this. So don't forget to share this with your friends. It's very important that you share. This is a very lengthy discussion, and I explained a lot of valuable things which might benefit a lot of students, which they might never have idea about. So please do share. I request all of you to share this video with your close ones and do help them to pass this paper, right? Because of this pandemic, not everyone can go attend face-to-face class. We are at home, so we need to take help, online help. We have to depend on the online courses. We are sitting at home, we are just studying from home online. We are just dependent on online. We are not having any face-to-face tutor. We are not able to go to our colleges. So please understand this. There are some limitations, but it's okay. We still will help each other, right? Because by helping other, you also get to know more, right? You help other, God will help you. So that's how it works. I believe in that a lot. And meanwhile, don't forget to subscribe to my channel, and thanks to all my subscribers. You have been continuously watching my videos till the end, and you give those likes and the comments which you give me, the emails which I receive from you people means a lot, really means a lot. I do take time to reply each and every mail, right? So if you have any doubts, if you want one-to-one class, don't forget to email me. Okay, and take care. Bye bye. Take care. Thank you.